Hey guys, thanks for all the questions, and by all means keep them coming. Now, before I get into my responses, I have to give my disclaimer. This video is in no way meant to be relied upon as a replacement for talking to your accountant. This is meant more as a guide, but you need to talk to your accountant before making any decisions. Everyone's situation is always, a little unique, and there's always like an it depends kind of answer. So enjoy, but make sure you're getting cozy with your accountant. This first question is from Sarah. So, is it better to buy or lease a vehicle? And if I lease a vehicle, what happens if I want to get out of that lease in the future? So, Sarah, great question, and most definitely a very common one in my world. The tax treatment for a leased vehicle is different than that of a purchased or financed vehicle. Lease payments are 100% fully tax deductible up to a certain maximum, which at the time of filming of this was $800. It may be higher by the time you're watching this. So purchased vehicles are deductible over time in what is called a capital cost allowance charge, or generically what we know of as depreciation. If you hold on to a vehicle for a long enough period of time, you essentially get to deduct the whole capital cost, right? If you finance the vehicle, you can deduct the interest costs against the income as well. So like leases, there are limitations to how much of the capital cost of the vehicle you can set up and depreciate, which at the time of this filming was about $30,000 plus GST or HST on the vehicle. There are exceptions for truly high-cost vehicles that are not luxury vehicles. The decision to lease or buy should not be as much a tax-based decision, because over a long enough period of time, the deductibility of it is virtually the same, but rather an economic one. What I mean is this: economically, you will end up worse off by leasing a vehicle, because in its rawest form, all a lease is a longer amortization period than a traditional purchased finance vehicle, with the option to return to the dealer sometime between when you lease the vehicle and the first purchase buyout date. While finance costs are not disclosed, you can rest assured they are factoring into the lease, into the lease payments. Furthermore, the dealer will have a lot of variables to play with to make a sale that may not always benefit you economically in the long run. Also, there are usually mileage restrictions, which can be quite punitive for exceeding. So here's the benefit. If you desire to be driving a newer car and do not plan to drive an unreasonable amount of kilometers, this may allow you to drive a vehicle you may not otherwise be able to afford. You cannot get out of a lease early, to the best of my knowledge, without getting hit with enough costs to not make it worthwhile. So if you plan to drive the heck out of a vehicle and you can afford it, you are economically better off purchasing the vehicle, because you will have a little more bargaining power with the dealer. You may be entitled to rebates, lower interest financing if you finance it, a shorter amortization period, so less finance costs, and like I said, you can still get a tax deduction every year. So this question's from Mark. How to cover working capital in a purchase and sale transaction? Can I just run up my payables leading into the sale, collect all the receivables, and pay out all the cash, or will that impact the purchase price? And how do I make sure I understand what working capital needs to be in the business to not affect the purchase price? So loaded question. The purchase and sale of a business is a very, very loaded question. Generally, here's how I see buyers and sellers deal with working capital in a buy-sell scenario. Usually, during the negotiation stage, a buyer and a seller will agree to a certain level of working capital to be in place at the transaction date. Remember, anything can be negotiated. For example, the buyer may wish to have a certain amount of cash on hand or a certain level of receivables collected prior to the sale. It's really, it really comes down to what is negotiated. So once this is negotiated, The purchase and sale agreement will include a working capital or price adjustment clause to use as a means to reduce or increase the purchase price for any fluctuations between the agreement signing date and the transaction date. Think of it like an oil tank. If you were to sell a home, if you agree to fill the oil tank but forget, the lawyers will reduce the purchase price by a predetermined value, usually equal to the market price of oil at the time that the liters in the tanks were filled up. So this is a very simplistic example, but it illustrates the point. This question's from Steve. So tell me about surplus stripping. Great question, but certainly way too complex to be addressed in this video. I'm sorry, Steve. This definitely requires a trip to the accountant's office. Surplus stripping has to do with the conversion of what would otherwise be considered dividend income, and it converts it to a capital gain on the disposition of the qualified small business shares, which in essence, triggers a tax shelter that, because the disposition takes place within a related group, the feds get very irritated about this. And that's about as much as I'm prepared to say. I'm sorry, Steve. Come see me. This question is from Todd. Should I take money from my tax-free savings account to purchase a new vehicle, or should I take the finance plan at 6%? As I'm sure you can appreciate, there's likely a whole lot of ifs, ands, or buts for this question, but generally speaking, if this is taking place outside of a business situation, the answer will likely be to draw out of the TFSA to avoid the interest charge, which is not tax deductible. However, you may be invested in something within the TFSA that is generating tax-free income, which is higher than the finance costs of the vehicle, in which case you may want to stay in and continue to achieve this level of income tax-free. This question is also from Todd. Another one that seems popular is, should I take CPP out at 60 or wait until another time in the future? So as most of you know, we have the option of electing at 60 to start collecting CPP, or wait until we're 65 or 70. So there is a penalty for early electing, and there's a bonus for late electing. All right? You can find out how much you will be getting by signing up for a Service Canada account and get your statement of contributions and estimated benefits. And you can do this by Googling form SC1SP-1003. Estimate request for CPP retirement pension and post-retirement benefit. That's the name of the form. Okay? When to elect depends on a whole bunch of personal factors. Your needs. Do you need the money now? For example, you need it to live, or could you start to use it to pay off high interest credit card, which would be much bigger benefit than the early election penalty. Your lifespan. If there's a history of shorter lifespans in your family, you may consider getting this now while you can. I know it's morbid, but it's just reality. This is definitely subject to discuss with your accountant, who can look at your specific scenario and do some planning. This question's from Sheila. How can I get paid on time every time? I spend way too much time on receivables, calling and texting and emailing, asking for payment. It's become counterproductive. Great question, Sheila, and one I have a lot of sympathy for. Receivable collection is an art for sure. Here's a bunch of tools you can put in your shed to help reduce the collection blues. Consider getting a credit card on file in the event someone goes over their terms. Place a high finance charge on overdue accounts. Now, if you do this, you got to make sure you disclose this fact on your invoice, and pick a higher interest rate, 18 to 24% per annum. You're not a bank, okay? Have this policy on a written form somewhere that the customer or client signs. And for God's sake, don't give people a pass. There has to be repercussions, or you'll continue to get walked on. Don't be afraid to send accounts to collections. It costs you valuable time and money to chase these. Let the pros take this off your hands. Be willing to go to small claims court. It's actually not that scary, from my experience anyway, and it's quite effective. If you're not already accepting all forms of payment, start. This is the 21st century and just a fact of modern day life. Even look at setting up a PayPal account and be willing to accept electronic funds transfers. Make it as easy as possible for your client. Send out regular statements, but don't wait 3 months to call. Start making a call shortly after the 30 days if you choose that as a credit term. You can also offer discounts for early payments, and I don't tend to see this a lot with the clients I service, but it is an option. I don't like it, but it is an option. Make sure you trust your instinct when you accept new customers. So 94% of the time, intuition is correct. That's what they say, and I believe it from experience that it's right, most of the time. So this question's coming from Mark, and it's two-part. One is to basically discuss LIRAs, which I'll get into, as well as CPP and OAS minimization strategies. So first off, LIRAs are short for locked-in retirement accounts. So these kinds of accounts are created when you leave an employer that has a pension plan. The LIRA is like an RRSP in that the growth appreciates tax-free, but you can't contribute to a LIRA and you cannot withdraw any monies until you're a predetermined age, which is generally about 55. When you reach the appropriate age, there is a minimum and maximum amount that can come out of the LIRA, so best to chat with your accountant as to what level to take out so that they can run some plans that contemplate the other incomes that you have. Okay, for CPP, you can fill out a form to split the payments with a spouse at source. However, keep in mind that in Canada, we have the ability of splitting pension income if you're at a certain age. Again, your accountant takes all this into account when preparing your income taxes on how much to split. And for OAS, which is the old age supplement, every Canadian receives this at age 65. Now, there are thresholds of family income that can create a clawback situation. The only advice I can offer here is, do not make irrational decisions to not spend money and thus live life for fear of losing the OAS. I know people are very emotional over the OAS clawback, but I've seen people so hell-bent on not getting this clawed back that they would not withdraw money from other areas just to reduce their income. So they win the battle and they lose the war. Get out there and have fun with your hard-earned money. You deserve it. I know it doesn't seem fair, but is it a big surprise that life is not fair? Okay, this question is from Nancy. What are you reading for inspiration these days, and what would you recommend as a good read for a small business owner like myself? Now, this is my type of question, but before I get into what I'm reading, listening to, and what I carry around in my briefcase every single day, I want to highlight one of the most important things a small business owner can do, not only to be successful, but also to really enjoy their business for an entire career. Always be learning. Read a book per week, or more if you can. Read blogs, listen to podcasts, subscribe to YouTube channels, start to build your vocabulary lingo so that you can talk to other business leaders, stronger business leaders that you can learn from. If you've decided to become a small business owner because you hate having a boss and want the freedom to do as you please, I want you to close your shop right now and go get a job. Because here's the thing, owning a business means you have numerous bosses and clients and customers. And at least in the short run, and maybe in the long run, if you don't do it right, you have less freedom, much less freedom. You must learn to see the perspectives of the entrepreneur, the manager, and the technician, even if you only gravitate to only one of these roles. A good business leader accepts his or her weaknesses and compensates by increasing their competencies in areas that they aren't comfortable with. So some of the best leaders I know are always learning and growing and testing their limits. They live outside of their comfort zone and they thrive on the opportunities that lie in failure and improvement. Okay, what I'm reading right now. Right now, I'm in my briefcase is Fanocracy by David Meerman Scott, which is about turning fans into customers and customers into fan, hence these videos. Lately, I've been reading some spiritual books, specifically Carolyn May's Anatomy of the Spirit. Absolute must-reads for owners are E-Myth Revisited by Michael Gerber, Start With Why by Simon Sinek, and Good to Great by Jim Collins. I love reading any leadership book, but I also like works rooted in psychology, and I have a long list of books in that area. I will do a whole video on books in my library, but the must-reads I've mentioned are the ones that I carry around in my briefcase and I refer to often. So great question, Nancy. Fire me an email if you want me to give you a list of those books, maybe even a condensed version. I can do that. This question is from Natalie. I have questions about RRSPs and TFSAs. I need to save for my children's universities as well as retirement. Okay. Our ESPs, that's Registered Education Savings Plans, are a great tool for this. They have similar characteristics as TFSAs and RRSPs, but there are differences, which are the RESP comes with up to a maximum of $500 grant from the federal government when you contribute. The RESP will create taxable income when you withdraw either to the child or the parent if the kid doesn't end up using it. So, question from Neil. The biggest question I had in the beginning was trying to get a sense of the typical tax advantages, the basics. Always lead with good business decisions, but first there are often a few paths to get to the same place. So Neil brings up a great point. While we need to always be mindful of the tax implication of the decisions we're going to make in our small businesses, reducing tax in itself should never be the motivation behind making decisions. Decisions should first be made based on whether they make good business sense. So for example, and I hear this a lot, people will look at their higher incomes and decide they want to reduce the tax by going out and spending money on things they don't necessarily need, at least right now, so that they can save tax. It's actually not rational. Rather than pay a portion of their income to the government, and if they're in a corporate scenario, it's a small portion, they purchase something they could do without, and they tie that capital up into something it's not producing income, or at least not to the potential it could be if it were purchased when it was needed. And remember, buying equipment or vehicles is a low bang for your tax benefit buck because we can only write off a portion of it anyway. So, don't let tax minimization be the tail that wags the dog. This question is from Adam. I heard recently that the Premier of Nova Scotia announced a decrease in the small business tax. How will this make day-to-day business easier for your clients? So generally speaking, it's a good thing that both the federal and provincial governments are reducing the small business corporate tax rate because it leaves more money in the company to reinvest in growing your business and becoming more efficient. However, you need to make sure you understand that while the corporate rate is reducing, the personal taxes created on dividends withdrawn from the company is actually increased. So there's definitely an incentive to keep those tax savings invested in your company as opposed to paying them out to you, the shareholder. Definitely something that is best to discuss directly with your accountant so she or he can do some planning. Another question from Adam is, for a business owner, which is more tax efficient or beneficial for compensation given the rules and regulations set forth by the federal government? Dividends or salary or a combination of both? Great question, but very loaded. There's a lot of specific situations which might warrant different combinations of salary and dividend. But speaking very generally, there's actually virtually no difference in the tax on salary income, at least in Nova Scotia, versus the sum of the tax on a dollar earned in the company and the personal tax on the remaining profit paid out to the shareholder. Now, salaries do attract CPP premiums, which as a small business owner, you end up paying double, because we have to match it. So you may decide to opt into a dividend-only strategy and endeavor to get better return than the CPP, which is actually not that hard. Keep in mind that for some trades folks, they need to have a WCB certificate, so there are minimum amounts of T4 income that we would have to make sure we salary. So all things to talk to your accountant about. Alicia came with, I think every small business owner that has a team can relate to the grueling task of training new hires. What type of training systems are out there, which are most successful, and how industry specific are they? This is a great question, and the answer is I don't know. I actually don't have any clients who use a third-party company to train their staff. I think that each company's processes would be pretty unique, and hiring a third party to create a training plan and execution plan would get very cost prohibitive, but I could be wrong, and please, if you're watching this video and you have a solution, like, let me know. It's just not something I see with my small business clients. I'm sorry. Now, Swain's has a development tool which we use that I'm always happy to show people, but here's the deal. You have to come in and have a coffee with me. Sorry, I'm a people person. Okay, this question's from Explain dividends for corporate small business owners. Okay, quite simply, dividends are distribution of after-tax profits. Dividends are not deductible against corporate profits, and you as a small business owner can decide how much you would like to distribute to yourself every year or how much you want to retain in the company to help it grow. Now, here's what I practically see day to day. Small business owners draw from their companies whatever they need to live. They just write a check to themselves, or they transfer the money from the corporate account to their personal account online. We, the accountants, will then declare a dividend that matches your draws. We take care of the legal resolutions and the T5 slip that reports the dividend to the CRA. There's other factors that your accountant may do some planning for that may affect the level of dividend you declare. But for all intents and purposes, this is generally how the process works. Now, here's a very important tip. Do not draw more out of your company than you're prepared to report on your personal tax return. This can snowball into a real mess, and I'll leave it there for now. If you are in that mess, talk to your accountant about a plan or give us a call. This question's coming from Chris. It is well known that a large percentage of small businesses fail pretty early on. Can you talk about this? Is it true in your experience? What are the warning signs of failure, and how can this be mitigated in the heat of battle? And ultimately, how can this be prevented in the first place? The general statistic that floats around is that 85% of small businesses will shut down within 5 years. Michael Gerber talks about this in his book E-Myth Revisited, which I highly recommend you read if you haven't read it yet. So here's some of the big reasons I see business fail. People get into self-employment for the wrong reasons. They've had enough to reporting to some asshole boss. They figure they can do it better. They think they can make more money and have more freedom and flexibility. And for a while that may feel true, but this is really the honeymoon phase. Eventually people start realizing that there's actually less flexibility, more hours, less money, and a roller coaster of emotions that they never counted on. And eventually they say to themselves, the only time I'm happy is when I'm out doing what I love, swinging the hammer or building the widget or what have you. And they shut down and they find a better boss and they do what they love to do, and they don't have to deal with 1,000 issues that small business owners must face every day. And they can take a legit vacation. Another failure I see is failing to really research whether there's even a market for the widget you are selling or the service that you're providing, and how many other competitors are already in the market. Another problem is they just can't sell. An owner that can't get out of their comfort zone and find customers that have problems that need to be solved, who can't communicate why they are the ones to solve it and land those sales. And no one can sell better than an owner. You can't offload this in the beginning, or arguably ever. Folks that have a hard time with difficult conversations, there is so much communication involved in self-employment that it makes the head spin. Having difficult verbal conversations with clients, staff, suppliers are a fact of life, and you can't hide behind email, text, fax, etc. If you have a hard time mastering radical candor, you will get eaten alive and eventually just close up. It's just too draining emotionally. The good news is that there are lots of ways to overcome this. Just give me a call. Here's some ways to mitigate closing your business. Understand that for your company to be successful, you need to ensure that 3 very key roles are fulfilled within your organization. First role is the entrepreneur. This is the visionary, the dreamer, the problem solver. Okay? The next role is the manager. This is the person that's calculating, analyzing, the realist role, the practical role. And then there's the technician, and this is the one that's out doing the core work that your company provides, swinging the hammers and doing the tax returns. Possibly one person can occupy one or more of these roles, but if you aren't covering off each of these roles in some fashion, your business will fail, pure and simple. If you're not an entrepreneur at heart, try to align yourself with one. This is a harder role to fill, but not impossible. And remember, you can't have a business full of entrepreneurs or nothing will ever get done. Become process-oriented. 92% of all problems in a business are process-related, not people-related. So we're quick to blame people generally because we see the symptoms of problems that are manifested in people. Errors, complaints, etc. But the root problem are generally deeper and systemic, right? Focusing on improving your process all the time is much better. Make time for that improvement, on time for your business versus in time. Allow your staff, if you have one, to take an active part in making positive changes to a process that will make their lives better. In most cases, they're more aware of issues in an organization than the owners. So make sure you're getting the real poop straight from the horse's mouth, as it were. This will create process owners versus renters. This question's from Steve. My curiosity currently is surrounding how to leverage my corporation towards investing in real estate income properties. Okay, if you are operating an active business that might someday be saleable, I would strongly suggest that you do not purchase passive rental properties in your operating company. There are much better ways to own this property under a corporate umbrella that doesn't involve your operating company owning it, rather a holding company. And I'll go deeper into this in another video. This warrants a whole other subject to sell, but this definitely warrants, a high-level discussion with your accountant. So folks, keep your questions coming. I love doing this. I love providing good, valuable content to small business owners. Our purpose is to inspire a nation of small business. So send them my way, and I'll keep chugging them out. Thanks, guys.